Good morning, everyone. Well, things seemed to be picking up yesterday. News that the IMF was on its way to Ukraine with a $15 billion rescue package calmed the markets and brought back some risk-seeking sentiment. That was aided by a better-than-expected U.S. durable goods orders figure and some soothing words from Fed Chair Janet Yellen. But overnight, a record decline in the renminbi turned sentiment around again, and risk aversion came back, causing a flight to safety into the dollar. Asian stocks were mixed, with China, Japan, and Australia lower. The risk-sensitive currencies, such as the Australian dollar, Canadian dollar, and Swedish krona, lost against the dollar, while the safe haven yen gained. The yen was aided by an above-expectations rise in the national CPI for January. That takes some pressure off of the Bank of Japan. Now, the anomaly in this pattern was the New Zealand dollar, one of the high beta currencies, that actually gained after the ANZ Business Confidence Survey rose to a near 20-year high. As for China, the renminbi fell, I calculated, 83% against the dollar. The biggest intraday drop in the 7 years that the current trading system has been in place. Now, the market believes that the Chinese authorities want to inject some two-way risk into renminbi trading so as to discourage people from putting on carry trades in the currency. It's also thought that the authorities are getting ready to double the trading ban for the currency as part of their program to liberalize FX controls and increase the global use of the currency. However, a weaker renminbi has the potential to inflict serious financial damage to Chinese investors who bought a certain kind of structured product linked to the FX rates. By serious, I mean billions of dollars in losses. Most of these products were bought by companies, including companies that have trust products outstanding that are already at risk of defaulting. So, this weakening in the renminbi has the potential to cause cascading defaults in the economy, widespread bankruptcy, and overall a slowdown in the Chinese economy. It's a serious risk to world growth. It makes me even more confident in my bearish view on the Australian dollar and temporarily bullish yen view, just on risk aversion. Speaking of which, the yen seems to have more room to appreciate than the Swiss franc on safe haven flows. Swissy yen just hit a record high at the end of last year and has been declining ever since. I think selling Swissy yen could be a good way to play risk aversion. During the European day today, the main event's going to be the Eurozone preliminary CPI for February, which is expected to have slowed to 0.7% year-on-year from 0.8% in January. After the slowdown in Germany's CPI yesterday, the market will be waiting for these figures, since a negative surprise will put pressure on the ECB to take action at next week's meeting. Eurozone unemployment is expected to have remained at 12% in January. In the U.S., we have a number of indicators coming out today. Please see the calendar on our website for details. Overall, the forecasts are for relatively poor data that could depress the dollar today. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, Global Head of FX Strategy at IronFX Global, wishing you solid trading.